Welcome to MarginBusiness Digital Entrepreneur Podcast. In today's episode, we got Emmett Kilduff. Emmett is the co-founder and CEO at the Fortia Group. The Fortia Group is an M&A firm focused exclusively on e-commerce exits. Welcome, Emmett. Thank you for making it today, Emmett. Very nice to have you here on the MarginBusiness Digital Entrepreneur Podcast. Let's dive right into it.
Great. Thank you, Omar, for inviting the Fortia Group. And hello, everybody. My background, I actually did a master's in e-commerce way back in 1999. So I've always had an eye on e-commerce. And that was the time of the tech boom when there was lots of really fascinating, .com stroke e-commerce IPOs happening.
Exciting times.
Yeah, exciting times. Came down to a big crash in the end, but it was exciting for a few years.
Yes.
And at the time, when I was doing my master's, because of all the excitement of all these tech tech, media, telecom, e-commerce IPOs, I put my hand up to join investment banking because I wanted to be part of this IPO boom. And so I joined an investment bank called Credit Suisse at the time, and did a lot of tech, media, telecom deals. And so a big part of my background is investment banking. Latterly, I joined Morgan Stanley, probably the top firm at mergers and acquisitions worldwide. I then left investment banking to start a data business called Eagle Alpha, which is all about helping hedge funds, private equity firms, and indeed aggregators of e-commerce brands use data to help drive their decision making. And it was through that a hedge fund client of my other company, Eagle Alpha, became a good friend. And one of his best pals happens to be Carlos Cashman, the founder of Thrasio.
Okay.
So I got introduced to Carlos back in June 2010, before really most of the world had heard of the term Amazon aggregators. And I became fascinated because I've done a decade in investment banking, a decade in data. And they're good skill sets to work in exits of e-commerce brands, because to me, Amazon is just a big data play. It's a data conundrum.
Definitely.
And so, having spoken to Carlos and felt his enthusiasm for the space, whilst it was still relatively small, I decided I've got to do something in this e-commerce world. So I freed up my time by becoming executive chairman of my data business, Eagle Alpha, so that I could become co-founder and CEO of the Fortia Group. And e-commerce entrepreneurs get the best deals possible on exit.
Okay, that sounds already really good. So your career actually, where are you from? Sorry, just to have a little background as well.
Oh, so yes, I was born in Canada, but raised in Dublin, Ireland, and that's where I'm dialing in from today.
Okay, that's very interesting. So Dublin, Ireland, born in Canada, obviously, and it's interesting because your M&A background obviously gave you a lot of data knowledge. Brought you to see the e-commerce side early in 2010, where Amazon was still I would say a little baby and a bit unrecognized by most of the people in Europe, I guess more in the United States, not so much in Europe. I wished I would have put my head like that early already in. I mean, I was already in, but I was as a service provider, I went directly in. So I was not, there was enough to do, So I didn't even have the time to think about selling at that point of time on Amazon. But it's true, at this time there was a real data need, and there were no tools which were actually helping in order to get the data out. And this was the important time. And as you done exactly the right thing. Normally what you should have done at a place like this, and we can speak about this later, but there are plenty of platforms. For example, there's Jumia in Africa, there is Lazada. I mean, Lazada now is at a bigger scale, but for example, Jumia, I would say Jumia is in 2010 is the same as Amazon now 2010, because now there is time to pull some data out of Jumia because they don't have the tools. So this was the same time for Amazon. So I think there is definitely a good entry point, was definitely a good entry point for you, and how to get into this market very early and get an analytical approach in the background, and then move on from there. How did it move on? I mean, like in 2010, when you had already your company there, or can you just break down a little bit more around that point? Sorry to interrupt your video. I just want to let you know that I really appreciate you having you here today, watching this video right now. And I wanted to let you know that MarginBusiness can help you to scale your Amazon business in the European Union from 30 to 50% through optimization and localization of your listings. If you have any questions, just send me an email, omar@marginbusiness.com, and I will jump with you on a call and explain further. Thank you and enjoy.
Yeah, so I started the data company Eagle Alpha in 2012 when I left Morgan Stanley. So it's been going just over 9 years. And for that business, it's all about leveraging data, right? So we as consumers create so much data. We leave a huge data trail behind us, whether that's from our mobile phone, our searching on the web, and so on, our footfall where we walk. And so this whole concept of using data for investment purposes started way back in the 80s, 90s, when people would literally count the number of people walking into the car park at Walmart, or the number of employees walking into a manufacturing plant in China. And lots of hedge funds made lots of money from that because it was really interesting proprietary primary research. But of course, now with technology, a lot of that can be done at scale, and empty cars or people in the car park in Walmart. Well, that then went to a helicopter, and now it's frankly done by satellites or geolocation data, and so it's done in real time. So you can get data to show how many people are walking into Walmart or Home Depot, etc. And then you can also get other data to think about the basket size, how much are people spending. And if you use all of that data, then you can start to try and predict the revenue of companies. So a lot of the clients of Eagle Alpha are hedge funds and private equity firms, but more recently the aggregators, Amazon aggregators, have become clients, and they want to use data to improve their lead generation capabilities, to augment their due diligence of brands, right? You know, they want to know everything about the brand they want to buy. And then their brand managers want data to improve the operational performance of a brand post-acquisition. So what data is available about the brand we've just bought, or indeed its competitors, and how can that help me as a brand manager on a day-to-day basis make better decisions to make sure we're winning the battle versus our competition?
Okay, thank you for that. That's very clear. When we move on afterwards, I mean, the beginning of the aggregators, and we're looking at all the different aspects, the different companies, the differences, the growth in Amazon as well. There was already e-commerce flippers. There were some smaller companies which were actually doing the sales, or let's say brokerage. There was more brokerage in place than direct people who buy and then might grow or take the seller by the hand and help him to scale while taking a percentage of the company. How got this into place? Because Amazon obviously in 2015 was already big in the US, but smaller in Europe. But you know, it took a proportion and grew very fast. Like I would say in the last since COVID began, it grew significantly. Obviously, there is a lot of investment money going in, a lot of big capital flowing, and there is still big capital flowing. So how did you got into this? What were your thoughts? I mean, without the data now, just for the analytical approach, the understanding of the whole view, how you got into this.
Yeah, it's really interesting. If you were an e-commerce entrepreneur, or specifically an Amazon seller 3, 4, 5, 6, 7 years ago, it was really difficult to exit. there wasn't any obvious exit route for intermediaries. Listing sites probably suited more towards smaller businesses. But there was no obvious exit, which was difficult for those entrepreneurs. They put their huge amount of energy into building something from nothing, and no obvious exit. So along came aggregators maybe 3 years ago at this stage, with a friend of mine, Richard Jolly Chandra, starting the first aggregator called 101 Commerce. Now, he was ahead of his time. He was a pioneer. Unfortunately, that didn't work because at the time, investors didn't understand the whole concept, particularly both the equity and the credit investors. And so he ended up selling his business to Goja, a business based out of Miami. But next up came Thrasio. So Thrasio has created, a whole industry, frankly, right?
Yes.
Carlos and Josh at the time had been very successful online marketing entrepreneurs, and they were advising brands on their marketing, but they were meeting too many small brands that couldn't afford their services. So eventually they said, well, let's buy some of these brands. We know how to turbo boost them from an online marketing perspective. And they bought 1, 2, 3 brands. And then they said, well, crikey, these brands are doing. To help create the industry, kudos to the guys, Billy Libby and co at Upper 90, because they sat down with Carlos and Josh and said, right, well, how can we be creative from a funding perspective here? What equity do you need? And also what credit do you need to pay for these companies? And that was really the start of this whole industry. Now it's $12.5 billion, 89 Amazon aggregators. And I think there'll be at least 20 billion raised by the end of next year, Omar. So it's only going to continue. The reason why it's so interesting is, and I've done corporate finance for 20 years, it's the perfect roll-up play. Private equity firms and people can set up roll-up firms of, say, hairdressers or dry cleaners or other types of businesses. But they're actually still quite difficult because you're dealing with lots of people, different cultures, and so forth. Amazon roll-up plays are relatively easy because most of even the big brands are run by 1 or 2 or maybe 3 people plus potentially some VAs. In the States, it's even easier because you just buy the asset as opposed to the whole company. So it's relatively easy to integrate. And especially in the earlier days, the valuations were very low, easy to integrate, easy to get some initial easy wins and upside. So it's a perfect model. And that's why you see all the equity and credit investors pouring in. And so it's really exciting. And people often ask me, is it a bubble? Is it going to burst? My view is absolutely not. Even if $12.5 billion is deployed, it's a really, really, really tiny percentage of the overall value of brands on Amazon. So, there's lots of room to go.
And then we come as well directly to the next question, because you mentioned 2022 and the changes there. And this was what are your predictions for 2022, moving on 2023? Because what I see, as you already mentioned, there is billions being raised. There is, every time I open up the internet, checking out news from the aggregators, there is another company who actually raised another round of funds, and it's growing so fast, and it's amazing. So, what do you think where we're heading 2022, 2023?
Well, I think more billions will continue pouring in. I think lots of big money will back the successful aggregators that are already in existence. So they will continue to get bigger money. If you look at Thrasio's raised 3.6 billion. Wow. Next is Perched and Heyday. So the ones after Thrasio will probably raise the same amount of money that Thrasio has raised. So incredible amount will come in. I think the game is over for new copycats of Thrasio. There hasn't been a Me Too launch, if you will, of Thrasio in several months now. I think the new launches that we see in the press at the moment are niche players, whether that's by geography, such as LATAM, India, South Korea, Japan, or by category, such as wellness or sustainability of supply chain. So I think there's 89 aggregators today. I think for the unit number of aggregators to increase, there'll be niche players. But the volume is going to get to at least $20 billion, and that's probably conservative. So what does that mean for next year? It means a couple of things. The first prediction is that deal sizes by aggregators are going to have to increase. They have to deploy $12.5 billion today, right? You can't do that with $1 million acquisitions. It's just not feasible. And it takes the same energy to do a $1 million deal as it does a $5 million deal or a $10 million deal. So the aggregators are going to do bigger deals. We've seen in Q1 this year, most aggregators had a $1 million floor for revenue of companies, and that for a lot of our clients, it's gone to 3 to 4 million. That's the first point. I think the second point is there's been a lot of headwinds in the last 2 quarters with supply chain costs, rising PPC costs. So unfortunately, that's been really tough for a lot of clients of your firm and my firm. And margins, some companies that had margins of 20% plus in Q1 are now 15%. And that means that those owners are going to have to be more realistic on valuation. There's no two ways about it. So valuations, I think there'll be a divergence in valuations. Those that have gone down, unfortunately, to 15% will have to be more realistic, but those that are 20, 25%, 30% will continue to get higher multiples because they'll be the ones that everyone's really fighting for. I think from an aggregation perspective, then, if that was the predictions on the brands, on the aggregation side, I think some aggregators will go bust next year. A small number of maybe 3 to 5. And that's really important for sellers listening because they need to pick the right partner. If typically 25% of consideration is deferred, you need to be working with the right firm that's actually going to be around and get you that earnout and look after your baby that you built. And ultimately, then the second theme for aggregators is the consolidators will get consolidated, which is a great phrase, and it's starting to happen. We saw just last week Allsam acquire an aggregator in the States. We've seen Berlin Brands Group do a small sort of acqui-hire in Germany. I think the initial stage of the aggregators will get aggregated is the distressed guys will get sold next year. And then the high quality aggregators will probably maybe towards the end of next year or even 2023. Because their investors won't want to exit too soon. They'll want to capitalize on shareholder value. Okay.
So do you see as well some kind of a merger between bigger aggregators or this is, you don't think so? Some kind of, that they might work closer together? Because what I've seen, there is a very big aggregator came out of Mexico, like in the last 2 weeks, I think. And there is another one as well, as you mentioned already, have been bought. I forgot the name actually, but there has been definitely one bigger one already acquired from another group. And there we can see shifts, which I expected them, but they happen very drastically, like there is still a value in the market. There is still a lot of cash coming in, and we see already these mergers and acquisitions eating up each other. So this is a very early stage already,
Yeah, I think the initial stage will probably be distressed, but it's also frankly hard for the distressed aggregator to successfully get sold because the buyer will look at their portfolio of say 20 brands and say, I like these 12. Don't care about the other 8. Okay. And then there'll be, then you get picked off, and that's not, so it'll be tough for the distressed aggregators to get sold. Maybe they have to sell on an individual brand basis and sell their entire company, or maybe the aggregator wants their whole team. So it's sort of an acqui-hire stroke acquisition of their favorite brands. And I think as we go forward, then I absolutely agree. The niche aggregators and the big aggregators will likely be acquired by other aggregators or indeed private equity firms. I think a key catalyst for all of this, Omar, will be when some of these big aggregators go public and list on the stock exchange.
Oh, this will be beautiful, yeah.
We think that'll happen probably towards the end of next year. There is one quasi-aggregator listed called Arterian, which used to be called Mohawk Group. It listed in the States. It actually started off as an incubator of brands, and it took a long time to get going. The share price peaked in sort of the start of this year, and it's had a tough year since. So that doesn't help from a comparable perspective. So it'll be really fascinating when Thrasio or a Perch goes to market. It'll be fascinating to see the multiples that they get from investors on the stock exchange. And when they are listed, it's easier for them to make acquisitions, right? So they will look for bolt-ons. And in fact, ahead of the IPO, they may look for specific bolt-ons to strengthen their story. So I think IPOs will be a catalyst for other M&A in the space.
Would this as well be a possibility for Fortia Group to go public, or is this a little bit far-fetched for now?
Well, look, I mean, the Fortia Group, we help the entrepreneurs do successful exits. We are still young in our journey. Have other corporate finance firms gone public? Absolutely. But at the moment, we're just, we're focused on doing at least 30 exits next year, 30, of e-commerce businesses, both on Amazon and off Amazon. And we're not looking too much beyond 2022 at the moment. But in theory, yes, we could go public at some point.
Okay, then we're already at the Fortia Group now. So can you tell us a little bit more about the Fortia Group? What are the goals and what is the main principles of the company? And maybe a little bit as well, how we already said, maybe what will be your goal in 2022? This is but it would be very interesting as well to tell the listeners.
So yeah, I guess going back to the reason why we set it up is to help ensure that e-commerce entrepreneurs get the best deals. And to do that, what we're doing is bringing a Morgan Stanley investment banking type approach to this whole space. So we're not a listing agent. I actually don't like the word broker. We're more of an investment bank. So it's full service, intense, bespoke advisory to guide the entrepreneur, hold his or her hand through the whole process to get the best deal. One of the ways we're different is we have an exit ready program, which means that we work with entrepreneurs 1, 2, 3 years out from exit, because fail to prepare, prepare to fail. It really annoys me that so many entrepreneurs sign an LOI within an aggregator contacted me in 2 days. You've invested so much energy. This is your big payday. Take your time. That's my big message for all the listeners. Take your time, prepare, start preparing a year out, 2 years out for your big payday. And from an exit ready perspective, we have sort of 2 threads. One is operational, one is corporate finance. So one of my co-founders is an e-commerce expert, and he works on a complementary basis with our clients to improve their operations, improve revenue margins, and make the business look like something the buyer really wants. The second is the corporate finance thread and work stream. So myself and my other co-founder, who's a finance expert, speak to the accountants, the lawyers, the tax advisors of the entrepreneur, help think about the KPIs and road test the concept with some friendly buyers. And between those 2 things, we can add a huge amount of value over a few months or a few years, so that when you do go into a formal auction process, all the ducks are in a row and you're ready and on the front foot instead of the back foot. And that allows you to get a competitive process really thoughtfully done. And ultimately that gets you the best chance of getting the biggest check possible, which is what we're all here for. Okay,
so the Fortia Group, I mean, what you mentioned it already, but maybe to shape it again in your own words, what makes you different from other aggregators? And as you mentioned, you're not a broker. So what is your strength? I mean, because from what I see, you help sellers actually to find the right time to exit. Can you just tell us in your own words what would this be?
Yeah, so we're we sit in between the sellers and buyers. So we're not an aggregator, we're not a buyer, we're not a seller, we're not an e-commerce entrepreneur. So we're an intermediary. And think of us as an investment bank. So think of us as like hiring a Goldman Sachs or a Morgan Stanley to get your deal done. We don't charge upfront retainers or monthly retainers. We only charge a success fee. So we only get paid if the entrepreneur gets his or her big exit. So that's all we do. We don't help entrepreneurs raise equity or raise credit or revenue-based financing. Our sole focus is exits, is getting people ready for the most successful payday possible.
Okay, that's already.
Yeah, sorry, Omar. And then so some points of differentiation. So I'm ex-Morgan Stanley, which is one of like the leading M&A firm in the world. So we're trying to bring the best practice down to this smaller e-commerce area. That's the first point. The second point is some of our advisors worked and set up aggregators. Anthony Johnson was the former CTO of Thrasio. He's one of our advisors. So we understand the buyers, and that really helps us prepare the sellers. Another point is, I mentioned one of our co-founders is an e-commerce expert. So we're not just expert, and that's really important to articulate the growth story of a brand, which is critical for getting a really high valuation. So there are some of the ways of we're different versus your typical broker or other advisor.
Okay, thank you. That's already very clear, and I think companies like yours don't exist too often. I mean, I have been speaking with a lot of brokers, a lot of aggregators, but in between like yours, I think it's a very unique project, and definitely helps sellers, Amazon sellers, in order to understand their business a lot better, because obviously when you sell and you hear a number, you want to sell, or you want to get out of there as quick as possible. So I think it's a very good approach. And just check out the Fortia Group. The website is thefortiagroup.com, correct? And where can anyone contact you or your team in order to ask questions or to get some more information?
Sure. So our email is exits@thefortiagroup.com, THEFORTIAGRUP.com. Yeah, exactly. And we have a really detailed exit guide that people are free to download. It's the best exit guide worldwide. 20 aggregators contributed to it. So it's a lot of really good content there for people that are serious about planning for an exit. We also host lots of webinars that are recorded and are available on our website. Later today, for example, we're doing a 1-hour webinar on how to maximize your valuation in 2022, and there'll be 3 aggregators joining me on that. So hopefully that type of content is helpful to your listeners.
I will definitely tune into that one. I already got the reminder of this, and I can confirm the downloadable file is very, very complete and has lots of information on there. So if you go through it, it definitely will help you to understand a little bit more if you want to sell your business, when you want to sell your business, and what is going on in the space and who to approach. Definitely the Fortia Group. Could you lastly give our listeners just a message, a general message for entrepreneurs, for sellers, for CEOs, for everyone?
Wow, that's a tough ask to distill it down. I mean, my key message I've done corporate finance for 20 years, and I've seen a lot of exits and transactions. And my key message, my key takeaway for people that have invested so much time and energy is just prepare. Fail to prepare to fail. If you want to get the biggest check ultimately, start preparing as early as possible. And even if it's 2 years from now, we're delighted to work on a complementary basis with the brand to make sure that ultimately they get the biggest check.
I think it's a very good message. Thank you so much for this conversation, Emmett. And yeah, I'm looking forward to see you today in the webinar. And thanks. Have a wonderful day.
Thank you, Omar. Thanks, Margin Business, for having us. Have a great day.
Thank you.